Hello guys, welcome back to today's video. In this video, we are going to talk about in-depth in liquidity and how it works and how it governs the market. So these are the points we are going to cover in this particular video. So make sure you watch this video till the end and leave a like if you like this video. So why does market feel rigid sometimes? I get a lot of questions that whenever I take a trade, I always hit my stop loss. And why does that happen? Market moves because it needs liquidity. Liquidity act as a fuel for price to move from one point to another point. Let us consider that there is a high and a low. Those high and low will act as a magnet for price to attract, and it goes from sell side liquidity to buy side liquidity. So that's why we always see some false breakout of certain highs and certain lows. Why? Because those are nothing but liquidity sweep. Now we'll see the logic behind it and why it happens. So this is how a view of an indicator look like. So I have applied multiple indicators. As you can see, there is no clear indication where the markets are actually moving. So indicators are basically lagging. They doesn't show you what price is trying to indicate you, but a clear price action, just simple drawing your lines, drawing your swing highs and swing lows. Here, as you can see on your right, this is a liquidity view. The high and the low act as a magnet. So this act as buy side liquidity and this act as sell side liquidity. Price move from sell side liquidity to buy side liquidity and buy side liquidity to sell side liquidity respectively. So what is liquidity and why it fuels the market? So definition of liquidity is simple, that availability of buyers and sellers at different price levels. So higher the liquidity, the smoother the price action. And when the liquidity is low, you can see that we almost always see consolidation or the price action is not favorable. That's why most of the time when we hit our stop loss, those are during low liquidity markets. So how you can avoid it, we will see in our next slide. So where fuel is stored in traditional markets, like if you're trading stocks, if you're trading futures, if you're trading forex, every this concept applies on each and every assets. So liquidity is provided by banks, institutions, market makers, and retail traders. It naturally, obviously, whenever you are taking a trade, the obvious area to place your stop loss is going to be this lows or this highs. That will create a concentrated amount of pending orders, then that will create for price to move or get attracted towards those liquidity pools. And how price hunts for fuel. So first here is you can see that there is a liquidity buildup. Price forms a clear obvious high above this level, a pool of buy stops order accumulated. And the second, liquidity grab. The price aggressively pushed through the high, triggering the stops and filling large orders. This is the refueling event. Third, the real move. With order filled and liquidity capture, the initial buying pressure vanishes and the price sharply reverses in the opposite direction. So decoding the map, buy and sell side liquidity. So buy side liquidity, the pool of buy stop orders resting above a resistance level or an old high, price must move up to capture those liquidity. Now, what is sell side liquidity? The pool of sell side stop orders resting below a supporting level or an old low, price must move down to capture this liquidity. So refueling stop versus fuel tank, that is gap versus the true breakout. So how to identify that there is a liquidity gap or there is a true breakout? A liquidity gap is a quick, sharp move through a key level following by a rapid reversal. The purpose was solely to capture liquidity before moving towards the other direction. And how to identify a true breakout? A sustained powerful move through a key level that continue in the same direction. It often happens after liquidity has already been taken from sell side liquidity and providing necessary fuel for a long journey. This is the strategy playbook you can use for your day-to-day trading. Now, how to trade using just liquidity flow? If price sweeps liquidity at a key high and low, then look for signs of reversal. If a stop hunt occurs, then wait for retracement to enter in the direction of the reversal. If analyzing a potential trade, then use higher time frame to determine the overall market structure and liquidity bias. So you can go from daily time frame, then 4 hour time frame, and then 1 hour time frame for your entry. Your new toolkit instrument for reading the flow you can use in your day-to-day trading. For identifying liquidity pool, you can use market structure, mark the high and low of that particular assets, then mark your order blocks. You can also use volume profile to identify a strong demand or supply zone. For context and bias, you can use VWAP, that is volume weighted average price. This is an indicator. I know in my previous slide I have said that indicator are sometimes lagging, but VWAP gives you a context, gives you a bias on a higher time frame. That is why I'm saying that the key level you should use VWAP on a higher time frame, like daily time frame, weekly time frame, and monthly time frame, because it will give you a higher time frame perspective when you are going to trade is during the London session, New York session. Asian session sometimes only if the price action is favorable, but if the price action is not favorable, only trade London and New York session because the liquidity and volatility is high during those session timing. So here are the few things you should avoid. Not every liquidity sweep will lead to full reversal. Context is everything. Focus on the higher time frame bias. A high impact news can inject unpredictable volatility and override typical liquidity flow that can cause for a stop hunts. So if you're trading high impact news, wait for market to settle. Trade after 5 to 10 minutes. Let the price give you the direction. Don't just trade aggressively on the lower time frame. But if you are a professional trader, you can definitely try it on your own risk. Okay. So on low liquidity, definitely causes sleepage. What do I mean by slippage? Slippage is nothing but the difference between the price difference between buyers and the sellers. Okay, so if the liquidity is low, the difference is much greater. But if the liquidity high, the difference is much more smaller. So that's why people prefer to trade only red folder news. So now the last point is over trading. Do not trade every liquidity zone. Focus on high probability setups that align with broader market structure. Focus on the higher market. If the so focus on the higher time frame. If the higher time frame is aligning with your lower time frame, then only try to trade that particular bias. So this is a flowchart. You can build your discipline. So be patient. Wait for price to reach a key high and low. Don't trade in the middle of a range. Avoid chasing. Never chase breakdown blindly. Analyze if it's a true move or a liquidity grab. Define the risk first, then take your trade. Your stop loss placement is critical. Always know your invalidation point before entering a trade. Journal your trades. So journaling is really very important because it will show you what kind of mistakes you have done, and you can learn from those mistakes, and you can avoid those mistakes in your next trading session. So here is the new workflow. So old view was markets are driven by random news and indicators. No, it is not. Markets are driven by logic, pursuit, and liquidity. Stop loss are just for personal protection. No, it is not. Stop loss are targets that provide fuel for major market movers. The goal is to chase breakdown. No, the goal is to fade false moves and trade the powerful reaction. So this was the video, guys. I hope you like this video. If you like it, please leave a like and comment what topics I should cover in my next video. If you want to join the community, the links is in the description. Thank you so much for watching, and see you in the next one.